Book and tax items. Let's talk about this even more. We want to make sure you're an expert at this by the end of this. Now, here are the following slides will contain more common book tax items that you may see on the exam. And we've got possible choices. So all of these items can create a temporary difference, a permanent difference, no difference at all, or a possibility of a combination of two or all three of these. So just depending on it, right? And let's dive through those examples rather than me, I'd probably start trying to get into it before even seeing those slides. So let's just see the actual slides and see what we're dealing with. Now, for gross income, dealing with sales revenue, this is always going to create a temporary difference. Now, as earlier said, in theory, could it create no difference? Sure, right? If we receive the income and earn it in the same year, that could create no difference. But for the exam purposes, yeah, it's going to create a temporary difference because that's just how we're going to, I've never really seen a question say, oh yeah, we received it and earned it in the same year. They're going to try to trick you for sure. Now, we here are going to provide the most common examples for you to memorize. I know, I'm not jumping in just yet. Whether it's sales revenue, other things we'll see, municipal bond income, stuff like that. But definitely use your brain and use your experience from the financial exam if you've taken that so far, and use critical thinking. Think about any experience you have in the real world, differences, cash basis versus accrual basis, any differences, book to tax income. Just take a step back, close your eyes, and think about differences. Because yes, if you memorize all these, awesome, great, right? But what if you don't have these memorized? Well, to which I'd say definitely memorize all of these. But also, theoretically, if they somehow threw something at you that you didn't see in this lesson, which, and like I said, these are the more common ones. These are pretty much what you'd see on the exam. But think, are these items going to possibly create a book to tax difference? Just use all your knowledge you learned from school and all of that. Just tips and tricks throughout as we go through. So 3 different types of sales revenue differences that create temporary differences. Well, installment sales, we go over this in other lessons as well, but for book purposes, revenue from installment sales, meaning you just get payments over installments, typically is going to be recognized at the point of sale because you completed your end of the bargain at the point of sale, presumably. Even if the cash is collected in multiple installments over time, this is going to follow accrual basis of accounting and revenue recognition principles. So if you are selling a car to someone, you sold them the car, but you get payments over time, you fulfilled your end of the bargain. You sold them the car, they have it. So you can recognize all that revenue right away. However, for tax purposes, and like I said, we've got all this talked about in other lessons where we actually go through calculation-based questions for installment sales. But this is going to use the installment method where revenue is going to be recognized as cash payments are received. And this can create a difference between book and tax revenue recognition. But it will reconcile at the end because you recognize $10,000 for selling a car. For book purposes, for tax purposes, let's say you will receive that $10,000 over the next 10 years. Boom, there you go. You'll recognize that as received. Long-term contracts. Now, construction, this might be, again, like there are a lot of similarities between the financial exam, the percentage of completion method. We've got long-term construction or service contracts. This is going to be a whole method on you recognize revenue as work is completed based on the percentage of the total contract that has been fulfilled. Now, for tax purposes, tax authorities may require the use of the completed contract method, basically saying you're only going to recognize revenue when the entire contract is finished. This also will create a timing difference because you're recognizing the revenue in different times depending on the situation. For prepaid revenue, when a company receives advance payments from customers for goods or services not yet delivered, so kind of different, the opposite of installment sales. So you're receiving the money now, but you haven't done your end of the bargain yet. You haven't sold, let's say you received $10,000 for a car, but you haven't given them the car yet. That's a prepaid revenue. You're going to record the payment as deferred revenue, a liability on the balance sheet. Gotta love our journal entries. This exam has a lot less, pretty much not that many as compared to financial or even audit. Make sure you know those because they help. The revenue is then recognized as the goods or services are delivered, in essence, when you fulfill your end of the bargain. Now, for tax purposes, some jurisdictions might require or allow companies to recognize prepaid revenue when the cash is received. Generally, yeah, when cash is received, we will recognize that, regardless of when the goods or services are delivered. And just like the other ones, this is going to create a timing difference, and it will be temporary. Dividend income. Here we go. Now, this can create a temporary or permanent difference, and let's see why. For our temporary difference, a corporation may recognize dividend income when it's declared for financial accounting purposes, but may recognize it for tax purposes only when it's received. So big difference there. Think about your journal entries, recognizing income when it's declared, but you haven't received the cash yet for book purposes, but you only are receiving it, you're only recognizing it when received for tax purposes. Now, this would create a temporary difference. You can probably think ahead now. The permanent differences, this is going to result in the dividend received deduction. This temporary difference up here, this is dealing more so with just the timing of when you would recognize a dividend that doesn't have to do with the DRD. Now, an example here, Company A is going to receive a $50,000 dividend declared by Company B, which is a domestic corporation, on December 30th, year 3, but the cash will be received on January 10, year 4. So we are recognizing it for book purposes in year 3, but for tax purposes in year 4. Now, the applicable DRD rate is 50%. For financial or book purposes, Company A will recognize the $50,000 dividend income when it's declared in year 3. However, for tax purposes, Company A recognizes the dividend income when the cash is received in year 4. This is going to create a temporary difference. And within the same dividend, we can have a temporary and permanent difference, right? Because in this case, even if there's a permanent difference, because of the DRD, that's great, right? But the eventual money we will receive, let's say of this 50,000, I know it gives a DRD rate of 50%, right? So it's $50,000 dividend, 50%, let's say $25,000 dividend, that's $25,000. That will be a temporary difference. But the other 25 that you're not going to have to report for tax purposes because we have a 50% DRD rate, that's a permanent difference. So we have 25 of temporary, 25 of permanent. Big important points to know. Hopefully this is very helpful. Gotta love those light bulb moments. I think they are wonderful. And I think this is one of those. Now, in year 4, when the cash is received and recognized for tax purposes, the temporary difference of 25 will reverse, and the book and tax revenue recognition will converge. Now, the DRD will still apply, creating a permanent difference for the excluded portion of the dividend income, as we explained. For permanent differences, this, as mentioned, this is going to be when you are dealing with the DRD. And let's dive right in now. Yeah, because of the DRD, it's going to be a lower taxable income always. Company A receives $100,000 in dividends from Company B, which is a domestic corporation. Here, our DRD rate is 70%. For financial, accounting, or book purposes, Company A recognizes the full $100,000 as dividend income. Now, for tax purposes, Company A can claim a DRD of 70% times $100,000. That is $70,000. That means that only $30,000 of the dividend income will be subject to tax. This $70,000 excluded is going to be a permanent difference between book and tax and revenue recognition. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.